All right, let's dive into one of the wildest, most mind-bending concepts in all of decentralized finance, the flash loan. We're talking about a tool that seems to break all the rules of lending, but it's totally reshaping the crypto world in ways that are both brilliant and, as you're about to see, incredibly dangerous. So just think about this for a second. What if you could borrow millions of dollars right now with absolutely zero collateral? No house, no car, not a single cent put up as a guarantee. It sounds completely insane, right? It's the kind of thing that should be impossible. Well, guess what? This impossible idea isn't just some theory. It's a real thing, and it has already powered over $3 trillion in lending. Yeah, that's trillion with a T. So the big question is, how in the world does this work without the whole system just blowing up? The answer is something called a flash loan, and it's exactly what it sounds like. An uncollateralized loan that you borrow and pay back all in the same instant. The whole thing happens inside of a single blockchain transaction. The key word here really is instant. It's a loan that literally exists for just a flash.
Now, the secret sauce here isn't some crazy financial trick. It's actually a core principle from computer science called an atomic transaction. This is fundamental to how blockchains work. Just think of it as an all-or-nothing deal. Either every single step in a series of actions is successful, or the whole thing is just erased, undone.
This diagram here shows you exactly what I mean. See the successful transaction up top? Every operation, 1, 2, 3, 4, it all goes through perfectly. But now, look at the one on the bottom. The first few steps work, but then, oops, operation 4 fails. Because of Atomicity, the entire chain reaction just stops and reverts. The whole transaction is undone as if it never even started. And that is the magic guarantee that makes these loans basically risk-free for the person lending the money. You know, a really simple way to picture it is like a chain of dominoes. Taking out the loan is the first domino. You can use that momentum to knock over other dominoes, make some trades, swap some assets. But, and this is the crucial part, the very last domino that falls has to be you repaying that loan. If for any reason you can't, the whole chain of dominoes just instantly stands back up. Poof! The lender gets their money back like it never even left their wallet. And this isn't some one-size-fits-all kind of tool either. There are actually different flavors. You've got your basic flash loans, you've got flash swaps that give you more flexibility, and even something called flash mints that can conjure up massive amounts of an asset for just a moment. As you can see, they each have their own trade-offs when it comes to fees, complexity, and how much money you can actually access. So who on earth is actually using these things? Well, according to a report from the Bank of Canada, flash loan users are what they call highly sophisticated actors. You can basically think of them as market wizards using this instant access to huge piles of cash to pull off some pretty incredible financial moves.
By far, the most common use case is something called arbitrage. So, a trader's algorithm spots a tiny, fleeting price difference for the same coin on different exchanges. This flow shows how they can instantly take out a massive flash loan, buy the coin cheap on one exchange, sell it for a bit more on another, and maybe even a third, all in a single transaction. They repay the loan and pocket that tiny difference as pure profit. In a way, they're like the market's janitors, cleaning up price differences and making everything more efficient for the rest of us.
And it's not just about arbitrage. This instant cash is also used for really important stuff, like liquidating bad loans to keep lending platforms healthy. It also lets people do really complex things like swapping the collateral on their loans or completely restructuring their debt, all without needing a giant pile of cash sitting around to get it done. It's all about making capital work smarter and faster. But, and you knew there was a but coming, this incredible power, this ability to wield millions and millions of dollars, even for just a moment, it has a dark side, a really dark side. Because with this kind of power comes an equally massive amount of risk. The very same tool that makes markets more efficient can be turned into a devastating weapon. And the stakes here are just incredibly high. As one developer put it on a DeFi forum, even the legitimate uses are this hyper-competitive, zero-sum game where it's all about speed. And that kind of cutthroat environment, well, it's a perfect breeding ground for both amazing innovation and, unfortunately, for some really malicious attacks. When we talk about malicious uses, they generally fall into two buckets. The first is wash trading. That's all about manipulation, using flash loans to create a bunch of fake trading volume to trick other investors. But the second one, exploits, is way more destructive. This is where attackers use that massive temporary loan to find and attack a vulnerability in a protocol's code for one reason: outright theft. So, how does one of these attacks actually play out? It's often this four-step dance you see right here. Step 1, the attacker borrows millions with a flash loan. Step 2, they dump all that money into an asset to temporarily and artificially manipulate its price. Step 3, this fake manipulated price then tricks another protocol into thinking something is worth way more than it is, letting the attacker borrow against it or just drain funds. And finally, step 4, they repay the original flash loan and just walk away with all the stolen crypto, leaving chaos behind.
Okay, so we've got this super powerful tool that's used for good and for evil. But what does the data actually say about all this? What's the true scale and impact of these different activities?
Well, if you just look at the raw number of times flash loans are used, the picture seems pretty clear. That giant pink area on the chart, that's arbitrage. It makes up over 75% of all flash loan events. So based just on how often they're used, you'd say this is a tool for arbitrageurs, plain and simple.
But frequency doesn't tell the whole story. Not even close. Now, let's look at the actual value of these transactions. We see almost 20 million arbitrage events, yeah, but the average one is for a pretty modest 26 grand. Now, look at the exploits. They are incredibly rare, only 539 of them in the sample, but the average value? It is absolutely astronomical.
The average value of a single flash loan exploit is over $56 million. So even though they happen way less often, the financial damage from just one attack is thousands of times greater than a typical arbitrage trade. This right here is the devastating, lopsided power of flash loan.
And that really brings us to the core dilemma, doesn't it? On one hand, flash loans are this amazing symbol of DeFi's potential, limitless capital, hyper-efficient markets. But on the other hand, they are financial weapons of mass destruction. So, is this just the price we have to pay for this kind of permissionless innovation? That's the billion-dollar or maybe trillion-dollar question the whole industry is trying to answer right now. Something to think about. Thanks for tuning in.